You're on.
Thank you. Okay, financial product, innovation, and engineering. So let's start. And then I would take really good notes because it's going to be on the in-class exam. And then if there's any, because I'm going to abbreviate because it would take me a long time to write out a lot of questions. If you don't understand what I'm writing, then ask me, what is that? Okay, so I can do that. And you'll hear when you get into the workforce, when you hear some of the senior executives speaking, we'll start talking about financial engineering and how we're going to engineer the financing of that project. And how we're going to engineer the balance sheet or the income statement, how we're going to finance the company, how are we going to engineer it. Okay, because it's not only the assets and the production of the product that generates the income, but it's also the liabilities of it too. So there's a lot of engineering that goes on here. So the first is, in creating financial product and pressuring firms to innovate, engineer the product, there's usually environmental pressures that are coming down on the company. And the first environmental pressure is going to be either competition or it's going to be regulatory change. Okay? And it's usually regulatory change, which is immediate. Long-term pressures, market changes, demographics, socioeconomics, those are longer-term trends that you can plan. But the financial crisis was here in 2 years. The system collapsed, and the result was the Dodd-Frank Act. And then all financial institutions, particularly the top banks, had to reorg their companies. So you had major reorganization and process redesign within the company. So environmental change. That's one of the bases. And usually it's through regulatory responses due to some type of crisis. Sarbanes, Oxley was the first, due to Enron and Arthur Andersen's corruption and basically showing the financial statements and audited financial statements as basically being unqualified from an auditing standpoint until they dug in there and found out that their company was basically a shell and totally levered up, and Arthur Andersen basically stamped the unqualified opinions on the audited statements. Okay. And the big response was that you had to have internal controls and you had to have executives in the company, the CEO, and CFO sign off on all the financials, which was the Sarbanes response. And then Dodd-Frank, I don't know if I spelled that right, and then Dodd-Frank, basically you had the Volcker rules where companies now had to put up capital, they were going to underwrite any of these securities. You had reporting requirements, commercial banks could not be investment banks anymore, they could not have proprietary trading units, so they had to spin off those units to hedge funds. They had to file underneath the bank holding company charters to become a bank, to go to the borrow at the Fed. And it basically reorged the companies from highly speculative, highly leveraged trading organizations to investment management companies and lending institutions. So it changed their organizational structures. And if you look at JP Morgan, B of A, Wells Fargo, Goldman Sachs, their organizational structures are different now than they were before Dodd-Frank. So it's really fascinating to look at this organizational change. When you're looking at environmental changes, you also have to look at the industrial psychology. You got to look at not only the industrial psychology of the industry, but the industrial psychology of the firm itself. You got to look at the group psychologies.
Exactly, right?
You got to look at the individual psychologies. Because a lot of them were motivated by a culture of criminality in these institutions. So the environment and the industrial psychology really dictate individuals and group behaviors within the firm. And again, that could be productive or constructive, depending on what is the culture internal of the firm. You have to look at the organizational structure. You're learning that in your organizational behavior and design courses, where you can analyze the priorities of the firm and how the firm's organizational structure matches that of the marketplace. Because the org structure matches the ability to interact with the external environment. And really looking at the change. You know, what is the pressure on the company to change its organizational structure and its culture and its internal psychology? And all of this is important to understand profitability of the firm. It all flows through to the intrinsic analysis that you will be doing at the end of the semester. All of this totally flows in when you're conducting your analysis of the firm to come up with a value. So the culture, leadership, styles, and this is a big one now, right? I mean, why didn't B of A COO, Wells Fargo's chief operating officer, why didn't he resign? Why didn't the board fire him for basically the corruption that basically they had allowed to go on to open up all those accounts on behalf of the customers by 5,500 people that got fired, and they said they didn't know about it. And Elizabeth Warren said, well, you didn't know about it, you're too big, and we should dismantle you under Dodd-Frank rules. So, you know, it all flows through, it flows down from the top. So it's leadership and management. It's also going to determine the type of product that they're going to produce, and how effective you are at it. You also have to have clearly defined strategy. And you have to have tactics. And you have to have operational planning throughout the process. And it's all going to be coordinated to really be able to innovate and maximize these products and be profitable. You have to constantly be looking at the competitive market. What is our competition doing? What products are they innovating? Are they stealing our market share from us? We can't afford market share, we're too big. So we gotta innovate new product, and we gotta innovate product and process that's going to create a comparative advantage so we can steal market share from our competition. Competitors can even drive them out of business in some cases, because it's a brutal market, it's brutal. I mean, the top 5 banks control 50% of the assets. An oligopoly, highly competitive, vicious market. You're telling me Google and Yahoo and Salesforce and Oracle and those and Amazon are not competing against each other? Oh yeah, they are. In a fierce competitive marketplace, always trying to constantly innovate new product. Product, process, innovation. Not only the product innovation, it's actually the process in which you are producing the services and the product. It's actually the process internally in the firm and how you manufacture things and how you interact. Are you interacting efficiently to create productivity that creates more efficiency within the firm? And that's really through enterprise resource planning. Are you allocating your resources efficiently within the firm? Are there bottlenecks and are there costs associated with the production? And this product and process innovation is constant. It's continuous. Product development. The process of product innovation never stops. Constantly plowing back money into research and development, internally into new product process design, constantly. What is your plowback? That you're plowing back into the company, which will eventually turn out to be internally generated funds for the firm and internally generated growth. Enterprise resource planning, ERP. Enterprise level monitoring, tracking, tracking of process and flows within the company, and you're constantly tweaking it to create productivity gains out of the technology and the process to not only design the product, but deliver it to the marketplace. You have to be responsive. You have to respond to markets. You have to recognize the client and customer needs. This was huge during the financial crisis and afterwards, when clients were coming to us saying, we want guarantees on our products. We don't want market risk anymore. We're scared of running out of money. Will you design product for us that will eliminate or mitigate market risk and eliminate and mitigate us ever running out of money in retirement? And they did. The market responded. New York Life responded with guaranteed annuity products, and within literally less than a year, controlled 50% of the market for that product. Took them a year to design it, and within a year, they control 50% of the market. Today, they control 40 still, because they got them locked in. So you got to recognize the client and the customer needs. You got to understand their wants. What do they want? Then you got to be able to design the product. Do you really understand your clients? Can you design, develop the product in real time? Very quickly. And that's through the R&D process, research and development. We're going to plow money into constantly looking to design new product and process. To be go after new markets or deliver new products to clients that we already have locked in for recurring income. Then the question becomes, do these products have the attributes to meet the needs of the clients? And those needs, again, like I said before, is to mitigate market risk. It's the first stock market risk. Running out of money over time. Hitting return objectives. Again, I need 8 to 10% to double my money every 10 years, or less than 10 years. I want guarantees, and I want quality product. I'm willing to pay the fees and the commission and whatever the cost is, just as long as the sponsoring company is a quality branded company with a good balance sheet, good ethics and morals and corporate governance, and has quality product that I know if I give them my money, the product is going to execute and do what it says it's going to do. And the product's not defective. And the company won't go bankrupt. Okay? That's the biggest concern for most clients when they're buying products, financial products, and investing with these companies. Product production and distribution. Some companies have really strong distribution networks. Schwab's a perfect example. Schwab, when I was working with them, they came out with a mutual fund, a stock mutual fund with a different style to it, mid-cap, growth, blah, blah, blah. They were able to market that new mutual fund to their registered investment advisory network. And within 48 hours, they had $5 billion under management in 48 hours. $5 billion in 48 hours. That's a lot. That's a lot. That's amazing. That is really amazing. So you gotta be able to quickly produce the product. And introduce it to the market so that people can communicate what it is. What is it that you're selling in simple terms so that people understand what they're buying? That's huge. And then you got to distribute it. Schwab was able to distribute it through, I think it was like 10 or 20,000 registered investment advisors that were in their network, running their businesses off their platform. So they already had the distribution channel. The question is, what are the marketing channels? And what is the mix? Radio, TV, print, social media, internal marketing communications. Different types of channels obviously are effective depending on the product and the service that's being marketed. Do you understand the optimal marketing channels in the mix to be able to do the distribution, do the marketing, and be able to maximize the revenue and to be able to get the money in as soon as possible? So again, just brilliant people who are designing this stuff. Also, production and supply chain management. Are there any supplier dependencies that would basically bottleneck your ability to distribute the product? Do you have gatekeepers or compliance that you have to get through that'll take 2, 3 days, maybe 2 weeks to get the product approved before you can sell it through the registered investment advisory network? So you have to understand the production and the supply chain and how to manage that. Distribution networks. There's other individual registered investment advisors outside their network that will sell the product. There's broker-dealers that will broker the product and sell the product. There's bank wealth advisors, in the banks that can sell the product. So the question is, do you understand the distribution networks? And then how to optimize it. And one of the most important is the sales and the sales cycle. Do these advisors and these salespeople understand the sales process associated with the product? How do you communicate the product? What does it do? What doesn't do? How much is it going to cost? What are the objections to the product? What are the objections to the firm? The objections to the product? The objections to you is the biggest objection. I don't want to buy from you. I don't even know you. I'm going to buy from my schmuck brother-in-law instead of you, because I know him and I don't know you. Seriously, you have to get through a lot of objections to be able to drive to a close. You got to be able to drive to the transactions where it was never worth it in the first place. So you have to have a very solid selling team with very precise language to be able to go through the sales process, the sales cycle. And this is one of the biggest things, and this was one of the motivations for doing this presentation, is because outside the business industry was telling me that your students don't know how to sell. They need to know how to sell. They need to understand the sales cycle process. They got to know how to sell. Even if they're going to be analysts or accountants, they got to know the sales process. Okay, so that was one of the requirements. And I brought this here along with the memos of the presentations. Business development. Marketing. And sales. Which brings it all together. And again, I've had people who have gone into accounting, gone into finance, gone into marketing, gone into ops, totally different areas. And they usually all work their way up and they end up becoming managing directors of business development, marketing, and sales. Doesn't mean they could have started off in audit on the accounting side. Now they're out there basically generating consulting and audit business for the accounting firm. They understand all the accounting, all the finance, but they also understand all the marketing. Okay, so they have both skill sets. And if you're lucky, you get to move into this because it's really fun. You get to meet a lot of people and you're bringing in revenue, and it's refreshing after you've burned out in one position for a long time. So the first thing is your marketing segmentation. First is, what is your market? What is the market that you're selling into? And the second is, how do you segment the market? Okay, because markets totally segment. And from this market segmentation, and I'll get into that in a minute, you are going to identify target markets. And you're going to customize marketing and communications around those target markets. And the way that you identify these target markets is through psychographic, demographic, socio-demographic, economic, and business. Psychographic, different types of lifestyles, demographic, age, race, gender, socio-demographic, geography, hierarchy, religion, economic, and business could be the size of the firm, number of employees, sales, size of the firm, or the firm within the industry. So again, you're going to customize basically the messaging, communication, and the sales cycle around these segments within the market, make them targets, and then design the marketing around that to be able to penetrate those markets. And from that, you're going to have clearly defined advertising.
Bless you.
God bless you. You're going to have clearly defined advertising campaigns, identifying the advertising mix, print, radio, TV, social media, you name it. What is the mix? But the key is, through these marketing efforts and through these advertising campaigns, you have to be able to calculate what your return on investment is. ROI. What is your ROI on your invested dollars in marketing and advertising? I'm going to expend $5 million on this marketing campaign that's going to generate X amount of revenue per year over the X number of years, and we are going to discount that back to the present based on some required rate of return, and we're going to see if our net present value is positive. If it's not, we're not going to do it. Okay? So we have to get a minimum return on investment that will make up for the costs associated with developing the program. Okay? And those advertising and marketing campaigns have to have a return. Okay? So the discounted cash flow models are extremely important in advertising and marketing. You have to be able to prospect. You have to be able to prospect new clients. Where do we go get the clients? How do we bring them in? How do we engage with them? How do we build the relationship we need to gain the trust to be able to talk with them, to make recommendations so that they can see what it is the solution is, and then to be able to get them to take action, to then carry through into the transaction. Get them to buy. So you need to prospect, and you get clients. And the key is, what is your conversion rate? We're going to send out 50,000 emails. We're going to get 5,000 responses. We're going to get 500 people who are interested. we're gonna get 50 that wanna do something and 5 that we can close on tomorrow. What's the conversion rates using these marketing tools and techniques? That's the key. How do you do it? How do you bring it in? And again, it gets down to the sales cycle. And it's not just the sales cycle, it's the velocity. And the scale. How many transactions can you do? How effective are you in going through the sales cycle and transacting? What's the velocity? Well, I can do five $1 million life insurance sales, right? Or I can do one 500 million life insurance sale, okay? So there's a difference between velocity and there's a difference between scale. And ideally you want velocity and scale at the same time, and then we're talking about some pretty big numbers. The most successful salespeople do velocity and scale, okay? And it's not a lot of velocity, but they figured it out, and they picked a certain segment of the market that they've targeted, and they have the competencies and capabilities to do a certain size transaction over and over again. And probably say, I'm not gonna do anything smaller than X, just gonna focus on these because I'm good at it now, and that's all I'm gonna do, okay? So you just elevate yourself through the process. The key is client, customer service. I already have them locked in. They're already a client. So all I have to do is call them up once a year, twice a year, 3, 4 times a year, maybe every other month, to tell them, hey, how are things going? Is the product working out for you? Are you happy? You know, do you need anything other help? Do you need any more help? Would you be interested in any other products and services that I can provide you? Do you have any other people that you think I should be talking to? Would you be willing to refer me to somebody with a personal note or an email or a call on my behalf? And if you thought I was good working with you, I'd love to work with other people around you. I mean, it's not just financial services. This is just, the process. This is happening to be a financial services lecture. Once you got good client and customer service, you got the client locked in. Once you got them locked in, then you have recurring income. You have recurring revenue. And when you touch them, you can upsell them to other products and services. Because people go through life cycles as they get older. They go through a life cycle. So you can follow them and their families throughout their whole life cycle. And if you're with the right institution, you can do intergenerational wealth planning. I can plan for the grandkids and the great-great-grandkids and the great-great-great-great-grandkids. So they never run out of money. So that they're living a standard of living that you want to make sure that your family is taken care of. Or your company, it's the same thing. And by tracking all of this, is customer relationship management, or CRM. And CRM systems with Salesforce and Oracle and others are huge now. And now they're using artificial intelligence, machine language and artificial intelligence to be able to manage the 2 or the 20 or the 200,000 or 2 million clients that you're tracking in your system. You would use a CRM system. And hugely competitive market space right now. Oracle, Amazon, Salesforce, IBM, Microsoft, you name it, they all have CRM applications for different scales of the enterprise. So the BlackRocks and Schwabs and JP Morgans would have these things. And actually the financial services industry, along with the real estate industry, has been fairly slow to adopt technology. Okay, so they're laggards within the adoption cycle of the technology themselves. So when you're looking at projecting, forecasting, because I want to forecast productivity gains within the company based on introductions of new technologies to be able to do things a lot better, Because I don't care if it's productivity gains or sales gains, you know, it's still gonna generate, it's gonna flow to the bottom line, and it's gonna flow down to the net operating income and the earnings and the dividends. It's all gonna flow down. I can compress the expenses or increase the top line revenue, doesn't matter at the end of the day. It's gonna create a multiple and create value within the firm. So the focus is really on either new technological innovation or new product innovation. And then the question is what is the adoption cycle? With the development and adoption cycle of the technology and the products. Okay. And the analysis behind that, for marketing and ops, people who might have been exposed to this, are either through what is called S-curves or product adoption cycles. And product adoption cycles are really important. We're introducing a new product. We want to know what the adoption cycle is. From the adoption cycle scenarios, we can forecast production, sales and revenue, and profits. I can do the forecasting if we know what the adoption cycle is. So basically what this is industry and company level projections. I was asked to sell my division at Schwab. I basically conducted this analysis. I looked at other examples of products that have been adopted in the past. I took those adoption curves and I basically projected out a revenue curve, you know, got to the NOI and the earnings, and was able to do the discounted cash flow analysis to figure out what the present value of my division that we were trying to sell. Okay, what we needed to do in revenue to make it return positive, net present value positive. So S-curves basically state that you have the technology on the y-axis, and you have time on the x-axis. And what you do if firms are successful, and if industries are successful, they are able to develop a series of technologies that go through curves. So technologies are developed, they go through accelerate within their benefits, and then they degrade over time. Either physically or functionally, they will degrade over time and then eventually become obsolete. So the ability, and if you look at IBM, and if you look at Cisco Systems and Oracle and those companies, they have basically been able to introduce a series of technological innovations over time, consistently and consecutively over time. We're at what, the iPhone 7 right now, with all of its technologies and product attributes. And there are state-of-the-art technologies within the iPhone 7. So the key is, can you, as a company or an industry, continue to technologically innovate to basically create an upward trajectory in technological innovation? I mean, this is going to be your, and can you do it continuously and contiguously? Continuously and contiguously. And there's a whole literature on S-curves. You know, learn more about it. But it's really, you're trying to project out a revenue curve. Now, for the company that introduces new products, it's a similar type of theory, but it's different. This comes from the ops side of the literature, the operations research side, the industrial engineering side. This comes from the product adoption cycle, that comes from the marketing area. And the product adoption cycle basically states, and again, at the end of the day, it's time. So the x-axis, it's adoption. Adoption, which is on the x-axis. Now, the first phase, when you first introduce a product, you're in the innovator stage. Okay, innovator stage. And this is where most startup companies are. Starting a new product, hiring a bunch of people, engineers, we're burning through capital, fixed cost allocations are really high. We either lose or we win. But usually the adoption is really slow in the early phase, and that's your innovator stage. So high cost, flat adoption. And you're going to go along, and you could go along for a while, you know, in this stage, depending on the type of product and the uniqueness of the product. It's probably a communication issue here, a marketing and advertising bottleneck here. But at some point in time, if it's a good product, and the communication, marketing, and advertising is correct, it's going to go through the roof. Okay? Especially now with social media and marketing campaigns. The ability to distribute now is way more impactful than ever before. And what you'll see is some kind of what they call a hockey stick approach, which means that all of a sudden the product starts to get adopted. And this is the early adoption phase. And a lot of firms go out of business in here too, because they totally underestimated the scaling factor, and they were unprepared, didn't have the right people or founders, they didn't have the supply chain in place, they couldn't handle the number of calls, they couldn't handle it, and they basically ruined their brand, burned through their cash, and then couldn't find anybody to buy them out, and they ended up, you know, going out of business, even though it was probably a great product. Okay, they just made mistakes. So in this phase, you're getting exponential growth in the revenues and the costs too, because the costs are going to be linear in most cases. But at some point in time, as you get to scale, your costs are going to collapse and your profit margins are going to blow up. Okay, because you start to get economies of scale. So you got to be able to scale early. And you got to be able to handle it. And this is your early majority adoption phase. And actually in this phase right here, you're generating cash flows, but the market is assigning you a huge multiple, so your valuations are really high. You've heard of unicorns? Have you heard of unicorns?
Yeah.
Unicorns are basically tech companies that either have little or no revenue, but let's say they have revenue or some kind of cash flow. And the market's applying like a 4,000 or 40,000 multiple on top of it to get to the $1 billion to justify the cost of acquisition, or the market value that the venture capitalists and other are applying to these unicorn high-tech firms. Now, this could deflate pretty quickly if they screw up or the product doesn't get adopted or their burn rates are really high. I'll talk about new venture capital funding later on in the semester. But the key is really this one right here. Can you forecast these product adoption curves? Because if you can, production, sales, revenue, profits, stock price, all come off of these pro formas, because you're gonna project these out. So you end up, you don't project out the pro forma based on some linear fashion, you're using exponential growth rates, okay, to mimic and replicate the adoption cycle, a similar product like yours that you've introduced in the past, or other products that have been introduced within your market, and you're using their adoption cycle to try to replicate what your revenue curves are gonna look like.
Are you able to project when you go from the innovator stage to the early majority adoption stage?
Yeah.
Okay. So that doesn't just come up and then you do the projection, you do it ahead of time?
No, you're probably gonna know. I mean, if you've been in the business long enough, particularly on the VC side or the tech side, you have a pretty good idea of what this looks like. The question is, if it doesn't materialize, what happened? You know, and it was probably miscommunication, it's probably over exuberance to the product. You know, maybe product attributes weren't as great as they were, and you miscommunicated, and you didn't have the distribution and the marketing channels to be able to get it to scale and turn into a hockey stick. And I've been with at least a few companies that have gone through this or tried to get through this and then failed because they ran out of money, and the founder was basically incompetent because he didn't have early startup company experience. He was coming from a different industry and he wanted to run everything, and we were telling him, don't do that, you don't know what you're doing, but it's like, sometimes the founders, you know, think they know what they're doing, but they don't. Okay? And then to be able to do this, you know, is important. And then you get into the majority phase. So everybody's got your product. Right? So you're in majority. Adoption. You know, exchange traded funds and stocks and bonds and life insurance, those are, everybody pretty much has them. Those are all majority adoptions, except for new products that come off of those. We'll go through this phase, but those broad categories of financial products are already fully adopted. Mutual funds, 401ks. So you're in the majority adoption phase. And then lastly is the laggard. Now, I'm gonna hold off, I got my BlackBerry, and I'm gonna keep my BlackBerry to the very end, and it's gonna take me all the incentives and everything to get an Apple phone. But I'm gonna hold off to the very end. So the laggard's basically coming at the end. So the question is, you know, what you can internalize these product revenue contributions into your company's revenues, or there may be a point where you say, hey, you know, the multiple is maximized, we're generating, it's time to spin off the company. It's time to sell it off to somebody else or to take it public as an exit. But the key to this is, can you do this over and over again? Do you have the right team, the right product, the right company, the right culture to be able to create basically successive new products and create an upward revenue curve? And to be able to do that, you're going to create a multiple for the firm and a valuation for the firm. But you got to be able to do it over and over again. New products continuously, contiguously over time to be able to generate the multiple to maximize the value of the company. Okay. And that's really the ultimate goal. So then, how do you evaluate these projects? How do you evaluate these products? How do you evaluate programs? Well, you use standard investment decision-making tools. Financial feasibility analysis, which is what you're learning now in the class, and you're going to learn in the second half of the class, even more. So how do you determine the financial feasibility of these new products? How am I doing on time? Financial feasibility. So, costs. You know you're going to have costs. Research and development costs, acquisition costs. These are some costs. Money's going out. You're going to have to get some money in at some point, but money's going out. and you're gonna need to get a return at some point. Revenue, free cash flow. That's the key. What's the free cash flow? Coming off of these products. What are your free cash flow projections? And free cash flow could be earnings before interest and taxes, EBIT, and adding back depreciation and amortization. That's usually the cash flow that they use to slap on a multiple to arrive at the value of the company after they've done the revenue projections used in the adoption curve scenario. From these, from the revenues, you're going to calculate the present value of these projected cash flows into the future, discounted back to the present. Okay, so I'm going to calculate a present value to your holding period. My expected return is 10% on the investment, and actually if we're doing new product development, it's probably going to be 22. I'm going to get some kind of cash flow in year one. I'm going to project out. Does that look familiar? Future value factor to get the cash flow in year two. And I'm probably, get to the terminal value stuff later on. But then you're going to add back some terminal value to the last year's cash flow, and you're just going to discount it back to get the present value. Okay. Present value, discounted cash flow methodology is the standard. That's it. Okay, that's what's used. Then you're going to subtract out these costs, acquisition costs, sales prices, whatever it is that could be development costs, R&D costs, could be the cost of acquiring another firm because you don't have the capabilities to be able to provide that input into the process. You may buy another company just to move into the market really quickly. It's going to cost you something, and the output is going to be the net present value, or NPV. Now, if the NPV is positive, then you're going to accept. If the net present value is 0, you're going to accept. If the net present value is negative, you're going to reject the product, reject the project. But I really want the project. I really want the project. I really want it. So what do? Well, if we can reduce this by the negative NPV dollar amount, I can get this to be this and accept it. So if I do a present value on the cash flows, subtract out the costs, and get a negative net present value, but I really want the project because in that case I would reject it. If I can lower the cost or lower the price or lower the acquisition price and the amount of the negative net present value, the net present value turns to 0 and we accept the project. We're in. Go back and renegotiate the price and reduce the cost of development. Figure out how to do it if we really, really want it. When the net present value is positive, your internal rate of return is greater than your expected return. So you're going to accept it. When the internal rate of return is equal to the expected return, you're gonna accept it. When the internal rate of return is less than the expected return, you're gonna reject it. So it's the logic. And then the last is break even. You hear all the time, when do we reach break even? We're gonna invest all that money in this, when do we reach break even? Okay. In large projects, capital intensive large projects, it's 3 years. But in faster growing industries and tech industries, it's 2 years. And super hyper growth tech industries, it's less than. So obviously the hurdles are a lot more stringent in some industries and for some products. And if we can't reach break even in the first year, we're going to scrap the whole thing and move on to the next project. And with technological innovation now, it's collapsed the break even points. Okay? Because there's so much productivity now through cloud and data processing, and artificial intelligence, and machine learning. It's collapsed the break even. So now we can put up little money and get really big returns because it's cheaper to do stuff now than ever before. We can bring products to market now in a nanosecond compared to what we had to do 10, 20 years ago. And then the last one is, and you might want to look this up, it's called a real option. We rejected the project out first, but we really, really wanted it. We couldn't get the price reduction, so we still had to reject it. We went back and looked at all our scenarios, the growth rates and the discount rates. We couldn't do anything. Net present value was still negative. Still rejected, but we really want the project. Okay, we really want this thing. So you go to a real call option value. And I'll teach you about real call options and option values later. But if the real call option value is greater than the negative, equal to the negative net present value dollar amount, you do the calculation, and they use it a lot in biotech and financial services. If the real call option value that you calculated is greater than or equal to the negative net present value, you're going to get a positive net present value, and you accept the project. So you go through iterations. And I'll go through this again. 4 or 5 more times, okay, so you understand it. But the key is you go through iterations when you're analyzing these projects, because you just don't want to reject them right off the bat. You want to renegotiate, you want to redo your assumptions, and then go to another technique to be able to see if it's true that the thing really isn't feasible. Okay? And then lastly is going to be, how do you get into these markets and how do you get out? If you see a market opportunity to introduce a new product, are you monitoring the market constantly and say, this is the time we need to introduce this product? And we need to introduce it now. Okay. Either we spend a year and develop it, and maybe miss the market, or we put all of our resources behind this thing and get it to market as fast as possible. And I think that's what New York Life did with the guaranteed annuities. Because they were able to bring it to market by 2010. And the financial crisis was basically over in 08, 09, and they had delivered the product by the end of 2010. So it was only like about 12, 13 months, which I found was pretty quick to market. So, market entrance and exit. Exit and execution. Can you enter the markets? Can you get out of the markets? Can you execute? And can you do it over and over? Do you have the right process and personnel? Well, to be able to enter a market and exit a market, it's got to be rules-based. You got to identify the metrics. That would basically trigger your decision to enter the market. Your rules-based, metrics have been hit, now it's time to get out. We either sell off the firm or take it public or do something. So it's rules-based, so it becomes unemotional. And actually, they surveyed the venture capital industry, and they found out that over 40% of decisions made in venture capital are not rules-based and emotional. Okay? Emotional. And they're probably making a lot of mistakes, but the wins are really big to cover up all their incompetent and bad mistakes because they're making so much profit. So when you win like really big. When you lose big, but you win really, really big when you win. So the key is no gut feel. Do not get emotionally tied to your product or your process. It's got to be rules-based. And then the last is exit. You need to create a capital event. You got to create some kind of capital event where you're going to have to divest the product or the process or the division through some kind of divestiture. You can either also spin off the company or the company line or the product line, and you can even spin it off and go to a initial public offering or an IPO. And a lot of people who work for a lot of these big companies get capital events, they make money through stock options, grants, bonuses. They spin off, they go develop their own products, they get bought by their firm as an exit at some point. Where the venture capitalists and the investment bankers will be there to nurture them, and then they take them public as the capital event. That's the motivation for doing it, is to make a lot of money through either getting bought out or exiting to the public market through a capital event. That's the goal. Okay. Whew. Any questions? Could you turn that off and then turn it back on again? Because I want to break up the lectures. Because I'm going to put some